Go ahead and record. All right. Hello, everybody, and welcome to Uber Freight's fourth quarter market outlook. With you today, my name is Russell Zupo. I'm the head of consulting and engineering at Uber Freight. With me is Nathan Adams, our vice president of procurement, and Mazen Danoff, who I call our chief economist, but he's the senior applied scientist that is heavily focused on the market and the economy. So we're going to have our normal agenda today. Mazen's going to kick us off with an overview of the market and what he's seeing happening in the market and reviewing that. I'm going to dig into a little bit of our data from our 4PL to kind of augment what Mazen talks about, and maybe a little bit on what I'm seeing in the consulting space. And Nathan's going to dig into procurement a little bit deeper and talk about what's happening in transportation procurement. So with that, I'll hand it off to Mazen.
Thank you, Russell, and good afternoon, everyone. Or good morning. So I'll be starting with a broader overview of what you're seeing in the U.S. truckload market specifically in terms of supply and demand, and then diving deeper into these supply and demand indicators, and ending with what we're expecting for spot and contract rates over the coming months. So in this slide, I'm showing the U.S. truckload supply and demand indicators, which we calibrate based on external data sources. The demand curve is shown in blue. The demand line is shown in blue. It reflects how much total truckload demand is available in terms of manufacturing, wholesale, retail, imports, and exports. And the black line is the supply, or how much capacity is there to hold this demand. The takeaways here is that nothing much has happened over the last year. So we're still in an oversupplied market where supply is outpacing demand. Supply continues to be above demand, which means that the market is oversupplied. Now, recently, the gap over the last year or so has been closing, but at a very slow pace. So you can see that supply has been flat while demand has been very slightly increasing. Due to factors mostly driven by the consumer and imports, as I'll cover later. But in general, both supply and demand are moving sideways. Both are about 0.2% or 0.3% above their year earlier levels, and the market continues to be oversupplied. So what goes into the demand index is three big components: wholesale, manufacturing, and retail, and these are shown in this slide. There's also imports and exports, but these contribute to a lesser degree. So starting with consumer spending on goods or retail, the first chart shows this index adjusted for inflation, and it's at an all-time high. So this is according to data from the US BEA, adjusted for truck tonnage. So consumer spending on goods is a positive driver for truckload demand. It has been at an all-time high. In the second chart, we see wholesale. And this sector is significantly below its all-time highs. So it's about 4 to 5% below the peaks that we saw during in 2022 or during the tight market. And it has been moving sideways. Similarly, if you move to the third chart, the manufacturing sector, that's where we see more and more struggles, right? So we are about 5% below the peak that we saw in 2022 during the tight market. The trend in the last 3 months has been downwards. So the manufacturing sector, or freight driven by manufacturing sector, has been contracting month over month for almost 2 years now, and including three consecutive declines in the last 3 months. So what does it mean for total truckload demand? We think that although truckload demand is up about 2% from the bottom that we saw last year, this is mostly driven by consumer spending and imports. But the two bigger sectors, manufacturing and wholesale, continue to struggle. That's why overall truckload demand continues to be about 3 to 4% below its peak that we saw during COVID, but slightly positive year over year. So a little bit more on what we're seeing on the demand side, specifically on the manufacturing side. The chart to the left shows the manufacturing PMI, or the ISM PMI index, which measures the overall health of the manufacturing economy. So the different colors refer to different months, and the way to interpret this index is that anything above 50 indicates expansion, and anything below 50 indicates contraction. And the index is made of these sub-indices for production, backlogs, new orders, etc. So when we look at this chart, we can see contraction across the board. Most of these indices are below 50. Production is below 50, which means production is decreasing month over month. Backlogs and new orders, these are two indicators of future demand. They also seem to be struggling. So this is a weak signal for future demand. Employment is below 50. This might indicate some layoffs in the manufacturing sector. And the prices sector are above 50, which indicates rising prices of commodities and raw materials. So we don't have any indications of a recovery in the manufacturing sector. Surprisingly, the chart to the right shows it does a different story in terms of imports. So imports are at an all-time high for the month of September. At least they exceeded the levels that we saw during 2020 and 2021, which were exceptional times that we thought they were never coming back. Now we are back at these levels. I think there are two reasons driving these imports. The first reason is the healthy level of consumer spending, as we saw in the last slide. So a lot of these imported goods are consumer goods. The second factor is that a lot of shippers were worried about tariffs and tried to pull their imports ahead of schedule, just to make sure they have their goods without paying extra for tariffs. So usually manufacturing and imports are correlated, but this time they're not. So that's all on the demand side. Now shifting to the supply side, I'll start with the trucking employment, or what you're seeing from data published from the Bureau of Labor Statistics. The chart shows total trucking employment shown in the black line. This is for hire trucking employment. And we can divide that into different sectors. I'm showing two sectors of these here. Long-haul truckload employment and less than truckload employment. Now, the key takeaway here is that the general trend is downwards, especially if we focus on total trucking employment. The trend is downwards. It's a slow downward slope, so it is not a fast correction. It's not a fast exit of capacity, but a slow downward slope. The employment is almost back to the levels that we saw in 2019. It's only about 1.5% higher, but this varies between sectors. So most of the reduction has been driven by the LTL sector, which was completely due to the yellow bankruptcy that we saw last year, which explains the sharp drop in the red line that we see in this chart. Meanwhile, the long distance truckload sector continues to be oversupplied. So it is significantly above the 2019 levels, which was an oversupplied market back then. So we continue to see significant overcapacity or excess capacity, especially in this long distance truckload sector, which is the bigger sector. Now we have signs that we will continue to see this capacity correction, which, as indicated by this chart, which shows spot and contract rates in the black and the blue lines, and the red line shows trucking operating costs, which are adjusted for empty miles. So these are the operating costs per revenue mile, because carriers, as you know, are not paid for these empty miles. The takeaway here is that carriers' operating costs continue to be about 20% above spot rates. So the spot market is unprofitable for most carriers, or most of the miles driven on the spot market are unprofitable. And of course, this includes all the costs from truck and trailer depreciation to fuel and driver compensation and maintenance. So once we consider all of these, the spot market rates are not sustainable for carriers. Even contract rates are about the same level as truck operating costs, which means that margins are thin, margins are disappearing. So a lot of even the contracted carriers, the contracted asset carriers are making very, very thin margins on contracted freight. So this is another indication that capacity might continue to exit the market until we see supply and demand come back in balance. So what are we expecting for the coming couple of months? This chart shows seasonal trends in Q4. So the chart to the left shows the October seasonal trends, and the chart to the right shows the December seasonal trend. And we can see how the market is expected to tighten from October to December as the chart gets gets hotter, right? Like the more red colors indicate hotter rates, specifically spot rates, especially in the Pacific Northwest, in the Midwest, in the Northeast, as well as the West market. So the only markets that will remain quiet for this period are Florida and Texas, where rates peak during the summer months. So especially in these produce markets. So this is just seasonality. We expect the seasonal push that we saw last year and the year before, but this year it seems that rates have been increasing year over year, and might continue to be higher than the levels that we saw last year. So speaking of rates, this chart shows trucking rates for 3 different modes: van, reefer, and flatbed in the top row. And I'll start talking about that. So spot rates are in black, contract rates are in blue, and we can see that we have seen a recent increase in spot and contract over the last month or so, or couple of months. If you focus on the gray bar, which are year-over-year increases or changes in spot rates, we can see that this long period, 26 months of negative year-over-year comparisons in spot rates, has come to an end as of June of this year. Since June, we have seen 4 consecutive months of positive year-over-year comparisons, indicating that spot rates are higher than the rates that we saw last year, during the same time last year. As of last month, rates were 5% higher than the year-ago levels. This is the largest increase we've seen since the freight recession has started. And we expect spot rates to continue to exceed their year-ago levels for the coming months as well. As for other modes, the chart below, the row below shows the producer price index, which is a measure of overall rates, including fuel. This is published by the BLS. So we're showing that for intermodal, LTL, and parcel. Intermodal rates usually follow truckload rates. They lag them by about a quarter. So whatever we see in truckload contract rates, we expect to see the same trend happening in the smaller intermodal sector. LTL rates have been increasing, especially on a year-over-year basis. The general trend is upward since the Yellow bankruptcy, which took a lot of capacity from the market, potentially ended the freight recession. So we continue to see year-over-year increases there. And with parcel, we continue also to see year-over-year standard or typical 5% or so year-over-year increases in rates. And with that, Russell will cover some trends that we're seeing in the 4PL data.
Thank you, Mazen. So looking at 4PL data, the first thing we like to look at is how our route guide's performing. So this might be a little small on this presentation, but the first chart shows what we call our first tender accept. So it's the first tender that goes out, whether it's whether you have a full route guide or not. And it's, as you would expect, remaining high. All the route guide performance is remaining very high. You can see it shifted from something in the 70% up to above 90, right exactly when supply and demand shifted from the first slide that Mazen showed. And then route guide compliance, which is maybe a little more important, is so maybe that first tender did a secondary or a tertiary carrier on the route guide pick up the freight. And that's just that's usually a few points higher and has a much higher floor on the downswing. So both of those remain really, really high, really solid. We see what I call a little dip from the first half of the year into the second half of the year. Probably that has a lot to do with shifting route guide, shifting carriers, and the bid cycles. But really, we're just talking about a point or two there. So we're still, I'd say, remaining very high. The third chart on this slide now shows a little bit more about what's the impact if your first carrier, if your primary carriers don't take it. And in the current market, it's pretty much a non-impactful event, right? So you've got some freight that's sometimes less expensive on the spot, and then other freight that, because you're doing it last minute, might be more expensive. So we're really looking at something like 1.5% here of an inflation by not having a primary carrier take your load. So that's kind of the impact, and you can see it's got the inverse sort of relationship with the market as well. If we break that down a little bit and we look across all modes, it's the same story. All the modes are pretty consistent. We do see, on the first tender acceptance, a dip in flatbed in the summer months. That's kind of a peak for flatbed, but honestly, the bottom row of charts, we're looking at van, reefer, flatbed, and intermodal. The top row is route guide compliance, and the bottom row is first tender accept. And the bottom chart has a much a different scale, actually. So we're actually going from 90 to 95% there in those swings. So we're really just talking a couple points. So for the most part, I'd say everything's horizontal, everything's flat, and there's no significant changes in carrier performance as far as accepting the loads. To look at specifically at service, what we've seen with service is there's just a slight dip, right? So you can see a kind of a downward trend on the far right of that top left chart. That's showing the overall service to the original must arrive by date. So we use that because it's one common metric that we have across all carriers. So there are a bunch of non-market related things that impact that, maybe manufacturing and upstream supply issues that could impact the shipper getting their original must arrive by date. And they may have changed that must arrive by date at some point too, to accommodate that. So the original one is sort of like the best and most consistent thing we can look at to create an index that gives us a sense of what is on time and what is not on time and how is it trending. And so right now we're looking at something in the neighborhood of, it looks like 75%. I think last quarter we were at 79%. So we are dropping ever so slightly as the market gets just a little bit tighter, but for the most part, everything I would say is fairly flat. And on the bottom of this, we're looking at different modes. And in fact, everything, while it's still flat, it's over a 2-year period. And while it's been dropping over the past quarter, a 2-year period, we're looking at kind of an increasing trend, a very slight increasing trend across all the modes and the overall index. So great performance from the carriers, great performance from supply.
Hey everybody, sorry for the technical difficulties. So I won't pretend to try to cover Zupo's deck at this point, but we can just kind of roll into the procurement world, and then if there's any further questions around some of the content that Russell presented, we'll be back on and we'll be able to have a Q&A. Oh, Zupo, you back?
I am. I'll go ahead and I'll wrap up here. Sorry about that. I was really hoping we'd have one of these without some kind of technical
we can't do that
here, but apparently the service just decided to eject me real quick. So apologize for that, but that's service. And kind of going into the next space here, this is sort of what we're seeing on the street in consulting. And it's some of this is the same as last quarter. I'd say from a transportation perspective, bids are in full swing. Nathan will talk about that. Shippers are really trying to lock in prices right now. Carriers, I would say we're starting to see on incumbents a little bit of an increase in rate, but generally that's not holding through all the rounds of the bid. So bids we're still getting savings in bids right now. Dedicated fleets and right sizing dedicated fleets is still a big trend. Kind of making sure you've got the right number of trucks and the right number of and the right business on your fleet. In the warehouse space, the construction pipeline is really low now. It's the lowest it's been since 2018, and warehouse vacancies are still rising. On the flip side of that, labor costs are very high. I think they hit a peak in August, but overall, I think the market is leveling, and it's posing, kind of setting itself up for demand increases next year. So if your company's looking for new warehouse space, I'd say it's a great time still, and probably going into next year. But at some point next year, things are going to start to flip a little bit in that space. Just kind of its own supply and demand curve. The other thing we're seeing quite a bit of right now is, and this has been a trend that was been going on for the past 2 quarters, is network design and strategy. Like the planning for network design is really high right now, higher than we've seen it for quite some time. And this is, companies are looking now to what does next year look like, what does the next 5 years look like. A lot of growth plans on the horizon. So that is what we're seeing right now. I will turn it over to Nathan to talk more about procurement.
All right, thanks, Russell. So yeah, well, it's always good to go last past these two because they always give the good macro setup for me when you start talking about what does it look like on the ground when you get to the procurement world. So just a couple themes that I grabbed as they were talking that kind of lands here. So you think about like thin margins, right? If you watch the carrier earnings, very mixed bag, right? Some folks are figuring out a way to scrape by in profitability. Some have found a way to increase revenue, but not profitability. Some have found a way to become more profitable, but not have the increase in revenue. So like super mixed bag, which just kind of speaks to the volatility in the industry right now and kind of what the carriers are trying to go through from a like oversupply standpoint. So it really is. There's still an oversupply out there. It's a battle for the carriers. We also work with the carrier base through the procurement team from a carrier management standpoint too, and so we have a lot of good insights from the carriers that I'll kind of weave in here. But overall, when we start talking about what does procurement look like, so we've really seen folks still kind of stick to that annual network RFP. I think this has been a trend all year. I think a few years back it was do I cut up my network? Do I piecemeal it out? Do I have multiple bids, right? So what we've seen most of the folks going to right now is just that one annual bid and then the maintenance of it, right? Which is also what we recommend from a best practice. It's good to set your baseline of activity, your baseline of capacity, and then maintenance it throughout the year through mini bids or as additional freight comes on or changes in your network, et cetera. So those mini bids and the maintenance of the network is critical as well. Just from an overall RFP activity, we've been pretty flat year to date. But I'd say our Q4 is already much higher than our last Q4. So when we look at that, we say, okay, there's a lot of folks starting to want to pull up their bids maybe into Q4 versus a historical Q1. There may be some indicators that they're seeing in their business that, hey, capacity is being tighter. We should probably go secure this on the front end of the potential rate increases or pressure in the marketplace. So we're seeing a lot of folks start to pull forward just from a safety net. And again, that's totally dependent on business. There's a lot of seasonality that works in that. So not every shipper is the same in those regards. Yeah, I'd say continuing on the trends, just shippers are starting to insulate themselves from predicted upturn in the contract market. Yeah, definitely seeing that of folks again pulling ahead their bids. Folks really trying to maintain their networks, and again, bidding the entire network versus select lanes. And what we are seeing is that most shippers have been working with their incumbents to try to keep them in place. It's getting tougher and tougher. It's some of especially the large publicly held carriers. Again, back to their earnings, there's some folks that just have to go get price. Mazen hit on the overall operating cost of a truck versus price in the industry, and when you're close to break even, carriers are gonna struggle. So they really do need that rate that larger than just a thin margin to really grow their business and help support the entire country from a trucking standpoint. So all I like to say is that there's a lot of folks that are struggling. We had breakfast the other week with some of a large carrier, and they are seeing progress in price, which I'll show you in the next slide. You can see it in our data too. They're seeing progress in price, but it's not widespread. So they feel like they've made a little bit of attraction, but they have not kind of got all the way back to where they want to or what they want to get to from a margin goal standpoint. Just from an overall carrier standpoint, sticking with that theme, they're still casting wide nets and bids. They less of a wide net than I'd say Q1 of this year, but still very heavy bid traffic on a per lane basis that we see in our bids. The incumbent carriers are trying like heck to hold their business, like I said, but then still try to work with the shippers to how can I get a little more margin, or how can I get some more profitable freight? But really trying to stick with those incumbents, and it comes to trying to stick with the shippers, right? They don't want to lose business at this point. And then again, Q4 carrier pricing, we've started to see less of a savings percent, right? So that tells you some price is starting to hold from a carrier standpoint. So I'll go to the next slide, and I'll explain this one a little. So the numbers on here, so don't look for the y-axis there. But all you need to know is, like, the higher on that graph, the more savings we're getting in the model. So if you look at the black line versus the blue line, the black line is our base scenario, where you kind of go all in with just the rates and capacity and whatever constraints you have in there from a shipper standpoint, and you kind of run it unconstrained other than just the base level, and you kind of get a savings output from the model. So I think the procurement folks in the room, they know how this works. They run the savings model, and then it takes a few weeks to kind of layer on enough constraints, have enough conversations to kind of get it down to what actually is going to fit in your network. So that base scenario is always going to show a high saves number, and then you're going to get to that realistic implementable scenario, which is kind of that blue line, right? So we track where are we coming in at in our base scenarios versus where are we finalizing at. And so what you see there is we saw the lines start to get a little closer together, which means that carriers are coming forward with a more aggressive rate up front. They're probably playing less games. They probably have less profit built into less margin built into their price when they're putting it out there. So that's one thing to track. The other is obviously on that line is decreasing. So we're seeing less save in our bids, right? Which speaks to everything we spoke about. It's definitely not upside down. We're still seeing savings, but it's just not as much, right? And I'll go to this next slide. And so just overall, best practices, what are we recommending? Again, it goes back to how you're working with your carriers and establish those strategic relationships. Like, this market cycle is an extended one, but markets turn up and down, and so the better you can partner with your carriers through the ups and downs on both sides of the house, the stronger relationship you're going to have, and the better it's going to be for your network, right? How do you establish long-term goals with your partners? How do you pull them into your company on strategic initiatives around technology and best practices? And you think these carriers, they touch a lot of shippers, and they've probably seen a lot of things before. So it's okay to ask those guys, like, what are you seeing in other networks? What do you have from a best practice standpoint? All with that, bringing them in closer, and all while still holding them accountable to things like service, right? So developing that formal process as working with them and holding them accountable as well. And just overall, that's going to build a broader strategic relationship. Obviously there's a lot of volatility, still a lot of things to be determined on what the rest of Q4 is going to look like, the holiday season, etc. So understand where your rates are to the market. Like, how do how close are you to market pricing? Is it beneficial for you to go out to bid early? Is it beneficial for you to try to extend rates? There's a lot of different plays in the playbook to run when it comes to what should I do in an RFP. I think some folks think it's like, I got to bid everything all at once. Some folks may have 10% of the network off to the side that makes sense to stick with their incumbents that they pre-negotiate. So it's good to have a strategy going into these RFPs versus just throwing some lanes out to the street, right? And again, stay close to your carriers, stay close to your incumbents, like, have those discussions, like, understand how they're pricing, what's going on in their business. And that way, it's not just a transactional, you submit a rate and I'll decide if I use it. You're actually having those strategic business conversations with the carriers to benefit the network on both sides of it. And I'd say that, a couple last points is, make sure you understand the tracking capabilities of your carriers. That's an evolving space, almost a, kind of table stakes at this point. So understand what we're doing in that space when you're working with your carriers. And then just the routing guide is going to be critical, right? So if things do start to tighten up the way it seems, back half of the year or whatever, I would recommend getting a, kind of a strong routing guide management muscle in place of where have I, fallen out of certain lanes, where am I over tendering, where am I under tendering, where have I have high rejection rates, and really get into the nuance of what your network's happening, right? And just from a management standpoint, you have to manage it much closer than we have in the past couple of years. So, And that is my last slide. So they may pull us all up on stage here for the Q&A, I think.
I think we may, oh, there's Monson. Perfect. So Nathan, are you going to guide our Q&A today?
I can, yeah. So this is probably a question for our marketing team, but I'll probably get it right. So yeah, the deck will be available. We'll publish all that after the call, so you guys will be able to go back through, watch that, go through the deck, and so a lot of that's already public knowledge. So thank you for that question. This may be a question for Moz, and not to put you in the spot just because it's spot rate related, but the question is, what can be attributed as a reason to cause the shift in the carrier market since June that resulted in an increase in spot rates?
Yeah, thanks, Nathan. So I don't think it's a change that's attributed to something that happened since June, but we have been seeing a capacity correction for the last year, or at least maybe more than a year, and we're starting to see the effects of that. So it might, in my opinion, it might just be the lagged effects of the capacity correction that we saw recently. So as I said, spot rates are slightly higher, like 5% higher than where they were a year ago. And I think that is one of the factors, the capacity correction that we saw. The other factor might be that over the last year or so, we've seen inventories mostly normalizing. So we're out of this inventory glut that we saw in the 2 years prior to this one. So it's not like something that necessarily happened since June, but maybe the lagged effects of corrections that happened prior to that.
Okay, thank you, Mazen. So next question, Zupo, you and I may need to double team this one, but just what kind of transformations are you seeing in the dedicated fleet space, or common things you're seeing? So I'll Zupo, I don't know if you want to talk about what you're seeing on the dedicated side, or I can as well. But.
I got this one, Nathan. So we're doing quite a bit of business in the dedicated side right now from a consulting standpoint. There's a handful of things that we're seeing. I mean, the first strategies are shifting just a little bit. So I mean, dedicated in itself is generally a strategy, right? It's a strategy that you're kind of securing service and capacity, usually at a slightly increased cost, but it is market dependent. So generally, we're seeing some companies, some shippers are trying to hedge against future increases by kind of expanding their dedicated fleets to more locations. But what we're seeing more than strategy shift is right sizing of fleets. So we're still seeing quite a bit of fleets that were grabbed and put out in place maybe during COVID when capacity was really hard to get, and they haven't been, like I would say, fully managed well. It's easy to fire and forget with a dedicated fleet. So we're doing quite a bit of fleet sizing, and then a lot of that is also, what is the business they're on? Are they on the right backhauls? Maybe, are you doing revenue sharing? So we even run into that situations where revenue sharing isn't happening, and kind of the carrier's double dipping. The other thing we're seeing a little bit more of too is continuous improvement and a little bit more management of the dedicated fleet. Again, there was a lot of fire and forget. Get them out there. Things are good. Service is good. I don't want to think about it. I got all this other stuff to worry about. So if you do the modeling and you do the right sizing, that really comes with monitoring and collaboration with the carrier then to support any changes you make, and then really kind of create operational efficiency, because the modeling you do and the analysis you do is going to create an efficient operation. But if you don't stay on it and manage it, then it's going to eventually slip back to where it was. So that's kind of the changes that we're seeing most often right now. Are you seeing anything different or added to that, Nathan?
No, you're spot on. I think I think it is. It's always capacity gets tight, dedicated fleets go up, right? Like capacity loosens up, they go down, and so again, to your point, it's easy to when capacity's loose and I don't need that fleet as much, just to kind of say I don't need it and get rid of it, but. There's some strategic value to potentially running that fleet even in loose times, right? For the shipper standpoint. So no, we're seeing the same thing. We're still seeing, what options do we have? Is there options for dedicated in my network? What should we be doing long term for next year? So yeah, still much the same.
Yeah, and I'd add to that a little bit too, in that I think in this sort of new market we've been dealing with, dedicated fleets haven't dropped as much as they have in the past, probably because of the level of uncertainty.
Okay, so I'm gonna jump back, Mazen, to the spot question because we had a follow up. So so expanding on the spot answer. So do you think it's more of because of capacity, or more because shippers want to be careful not to push the contract carriers too far, given that they're under a lot of cost and pressure?
Yeah, so that's a great point. When it comes to contract rates, we've heard that asset carriers are pushing back against like significant rate cuts. Maybe Nathan, you can. I don't know if you're seeing that as well, but I've heard that a lot of carriers are pushing back against the contract rate decreases. I think if we go back to the slide where I showed spot and contract rates versus operating costs, we can see that spot rates went significantly below operating costs, while contract rates did not. So that reflects the fact that carriers are not willing to commit to long-term rates that are unprofitable for them. So I think that definitely plays a role in setting that floor on contract rates, which we haven't seen in spot rates. So spot rates went below that floor, while contract rates did not. So yes, I think that is a great point.
Yeah, thanks, Mazen. Few more here, and if anybody has any last questions, we got a little more time, so please drop them in. So question for me, so what was the method if you have new lanes and you're doing a new sourcing event and you have some specialized equipment needs, whether it be drop trailers or any other kind of lane attributes? And so yeah, that goes back to that procurement strategy on the front end. Is how do you look across your network and understand the needs on each lane? So if you think you take a very large network like a lot of us have, you're going to have requirements around drop trailers. You're going to have requirements around noise ordinances. Heck, you may have something that needs flatbeds, or maybe there's store builds or something you're trying to do as a retailer, and you're shipping heavy product, heavy haul. So all that is specialized, and so once you kind of get out that just average, hey, I need a truck from A to B, like I don't care what it is, I just need something to move. You really got to get into defining those lane specifications and get very detailed on those lanes, because you're going to want a lot of that information up front, so you can again make sure the carriers are pricing it right, make sure they know how to service it correctly, and basically just make sure you have all the equipment you need in place before the bid go live, right? So in the case of drop trailers, for example, depending on the volume, you can back into how many drop trailers I'm going to need at each side of the origin destination. And then, it may be a, whatever, 2 to 1, 3 to 1 tractor trailer ratio or load to trailer ratio that you have to work with the carrier on. And it's important really to communicate to them. Says, hey, I think I'm going to need additional trailers in this lane. I've done procurement events in the past at my old shop where, the trailer need was very intense outside of what a normal drop trailer program would be. And so, yeah, it's going to cost more, but if you don't put that into the RFP, you're going to get rate increases come back your way anyway, and it'll be more difficult to navigate through. So that's how I would recommend taking care of any kind of specialized equipment needed when you get down to the RFP level. Okay. All right. So another one for Mazen. So Mazen, what type of economic indicators are you looking for that would signal the end of the freight recession?
Thanks, Nathan. So I'll mention a few. The first one is we talked a little bit about manufacturing. So the early indicator of that is manufacturing orders, orders of capital equipment, core capital goods. So these are early indicators that might tell us what's going to happen with future manufacturing demand. This is a huge driver. Another factor is, and this relates to the Fed lowering rates. It is mortgage rates. So we haven't seen, even though rates have decreased, we haven't seen a decrease yet in mortgage rates. Mortgage rates play a role not only in there are effects beyond the housing market, especially in the goods that are related to the housing market, like furniture or appliances or building improvement or home improvement goods. So these are sectors that were struggling in the last 2 years. And we haven't seen a recovery yet. So these are tied to mortgage rates. And then we talked a little bit about wholesale. So what's happening in wholesale demand, wholesale inventories versus sales. So these are the indicators I'm looking at.
Okay. Thanks, Mazen. So question here, I'll take a stab at. So are we seeing a large gap in rates from asset-based carriers as opposed to brokers? Yes, in some cases, I'd say, yeah, you know, your brokers are always going to be a little more aggressive on that pricing model, right? They're going to, whereas your asset-based carriers, they know their costs, they know their, you know, what it's going to cost for tires and driver, you know, W-2 and all that fun stuff, and all the things that make up your pricing model. They're going to know exactly what they need from a price standpoint. Brokers are going to go out and try to speculate a buy and what they can buy for, and use that to go try to win business, right? So, you know, usually that's what in loose markets, the brokers can go in and usually secure a lot of freight because they may be able to go hire carriers that have niche markets or, you know, are not as profitable or are backhaul lanes, right? And really get down to that truck each level instead of getting to that macro large fleet level. I'll tell you this, that like we're starting to see where, you know, some of those broker rates and some of that broker capacity is dissolving, right? So I think Mazen hit on it on just the oversupply is allowing those brokers to bid cheap right now, right? Or cheaper than asset carriers. And so as that supply starts to move out, like that will go away, right? But as of right now, yeah, we're still seeing a differential in those rates. Not in all cases, and you know, it's not carte blanche, but it's you know, it's definitely in pockets. You see that still happening. Okay. I think that may be all the questions. And I know we're right at time, so if there's nothing else, I can wrap us up.
So I'll say this real quick. If we didn't get to your question, we do tend to review these after, and we'll get back to you individually on the Q&A.
Totally. Okay. Well, again, thank you all for attending, and we really appreciate the time. We know everybody's time is valuable, and appreciate you spending with us. And again, you know, please be on the lookout for recordings and decks coming your way. So thank you again, and we'll see you Q1 for an update.